$11 trillion vanished from American household wealth in 2008. Homes, jobs, savings, gone. Risky mortgages were sliced, rated AAA, and multiplied until nobody knew who held the danger. Then prices fell, Lehman failed, credit froze, and housing became a global emergency. Congress authorized up to $700 billion for TARP. Rewind. Housing only goes up. After the dot-com bust and the September 11th attacks, interest rates fell. Borrowing became cheaper, investors searched for better returns, and housing looked like the calm, sensible answer. Home prices had already been rising for years. Rising prices made owners feel richer, builders busier, and lenders safer, because a troubled loan could seemingly be rescued by selling the house. Global investors wanted American mortgage bonds. They offered steady payments and at the top of the stack coveted AAA ratings. Demand for loans became demand for raw material. Government policy had long encouraged home ownership, while lenders, brokers, builders, and Wall Street all earned money when another mortgage closed. The machine rewarded motion, not patience. Each successful sale seemed to prove the story. Prices rose because credit expanded, and credit expanded because prices rose. It was a circle wearing a very respectable tie, but a boom needs more buyers. Once conventional borrowers were not enough, the mortgage industry went looking for customers it had previously rejected. Subprime mortgages served borrowers with weaker credit histories. That label did not make every borrower reckless. It meant the loan carried more risk and usually more expensive terms. Many adjustable-rate mortgages began with a low teaser payment. Later, the rate could reset higher. The first payment looked friendly, the future payment had been left in another room. Low documentation and no documentation loans reduced the proof required for income and assets. Brokers could move applications faster, and the lender often planned to sell the loan anyway. Mortgage brokers were commonly paid when a loan closed, not when it performed for 30 years. That difference turned careful underwriting into an obstacle between the broker and the fee. Originators could sell mortgages into Wall Street's pipeline. With the credit risk moving away, volume mattered more. The person approving a loan might never see its first reset. By the middle of the decade, the system was producing mortgages that worked only if refinancing stayed easy, payments stayed manageable, or home prices kept climbing. Wall Street pooled thousands of mortgages into mortgage-backed securities. Homeowners sent monthly payments into the pool, and those cash flows were passed through to bond investors. The pool was divided into layers called tranches. Senior layers were paid first. Lower layers absorbed early losses. This rearranged risk. It did not make risk disappear. Credit rating agencies gave many senior mortgage securities the highest grade, AAA. Their models leaned on historical data from a market that had never seen this exact lending boom. Then came collateralized debt obligations, or CDOs. Riskier slices from many mortgage bonds were gathered, repackaged, and divided again, producing new AAA layers from old leftovers. Synthetic CDOs went further. They used credit default swaps to create additional bets on mortgage performance. The same underlying mortgage risk could now support multiple winners and multiple losers. The paperwork grew more sophisticated while the underlying promise stayed brutally simple. Enough homeowners had to keep paying, and nationwide prices were not supposed to fall together. Financial firms borrowed heavily to hold mortgage assets and finance trading inventories. Leverage magnified profits while prices rose. It would magnify losses with exactly the same enthusiasm. Much of this borrowing was short-term. Firms repeatedly rolled over funding in repo and commercial paper markets. Long-lived mortgage assets depended on lenders returning every morning. Important credit creation moved through the shadow banking system. Investment banks, money market funds, securitization vehicles, and other institutions without the same safety net as ordinary insured deposits. Credit default swaps looked like insurance on bonds, but they also linked firms together. A loss in one portfolio could become a payment obligation somewhere completely different. AIG sold enormous amounts of protection on mortgage-linked securities. When those securities lost value, collateral calls rose, and the insurer needed government support to avoid collapsing through the network. The system looked diversified because risk had been spread everywhere. That was also the problem. Nobody knew exactly where it would surface when housing turned. U.S. housing activity peaked in 2006. Construction weakened, prices stopped climbing, and the easiest escape route for stretched borrowers, refinancing into another rising home, began to close. Adjustable payments reset higher just as home values flattened. Some borrowers could not refinance. Delinquencies rose, especially among recent subprime loans with thin documentation. Mortgage lenders began failing. New Century Financial, once a major subprime originator, filed for bankruptcy in 2007. The raw material factory was breaking before Wall Street admitted it. Two Bear Stearns hedge funds loaded with mortgage securities collapsed in 2007. Their losses showed that supposedly tradable bonds could become impossible to price when buyers vanished. Banks stopped trusting both the assets and each other. If nobody could value a mortgage bond, nobody knew which balance sheet hid the next hole. In March 2008, the Federal Reserve supported the emergency sale of Bear Stearns to J.P. Morgan Chase. The rescue bought time. It did not repair the machine. That summer, confidence kept draining. In September, the government placed mortgage giants Fannie Mae and Freddie Mac into conservatorship, supporting institutions tied to trillions in housing finance. 1 week later, Lehman Brothers ran out of options. Counterparties demanded collateral, short-term funding disappeared, no buyer arrived, and Lehman filed for bankruptcy on September 15th. It was the largest U.S. bankruptcy filing in history. The failure did not stay inside Lehman. It changed what every institution believed could happen to every other institution. A large money market fund holding Lehman debt broke the buck, meaning its share value fell below $1. Investors rushed to pull cash from funds used like safe parking. AIG came next. Its mortgage-related guarantees triggered crushing collateral demands. The government intervened because AIG's failure threatened to send losses through its web of counterparties. Washington Mutual failed on September 25th with about $307 billion in assets, still the largest bank failure in U.S. history. J.P. Morgan acquired its banking operations. Commercial paper and interbank markets seized. Companies that had nothing to do with subprime mortgages faced trouble funding payroll and inventory. The housing crisis had reached the real economy. The first rescue bill failed in the House, and markets plunged. Days later, Congress passed the Emergency Economic Stabilization Act, authorizing up to $700 billion for TARP. Treasury first used TARP mainly to inject capital into banks, not to buy every toxic mortgage. The aim was to strengthen balance sheets and restart lending. $700 billion was the original authorization ceiling, not the final amount spent. The authority was later reduced, and Treasury ultimately dispersed substantially less than that headline number. The Federal Reserve cut rates toward zero and created emergency facilities to support funding markets. It also expanded its balance sheet and later purchased large quantities of mortgage-backed securities. TARP also supported the auto industry, AIG, credit markets, and foreclosure programs. One emergency law became a toolbox for several emergencies arriving at once. These actions helped stop a financial collapse. They also created a lasting political wound. Institutions received rapid support while households experienced a much slower rescue. The numbers were vast. Federal Reserve officials reported that roughly $11 trillion of U.S. household wealth disappeared in 2008 as home values and financial assets fell. Millions of households lost homes during the broader Great Recession. Foreclosure was not an abstract red line. It was a notice on a door and a family forced to move. U.S. non-farm employment fell by about 8.7 million jobs from January 2008 to February 2010. Unemployment reached 10% in October 2009. Real gross domestic product fell 4.3% from peak to trough. The recession lasted 18 months, the longest U.S. downturn since World War II at the time. The damage was uneven. Families with fewer savings, communities hit by concentrated foreclosures, and workers in construction and manufacturing often had less room to absorb the shock. The recession officially ended in June 2009. Recovery did not feel official. Jobs, home equity, and trust returned on very different schedules. The crisis reshaped regulation. The Dodd-Frank Act created new oversight, required more capital and liquidity, brought derivatives into clearer rules, and established a process for handling failing giants. It also created the Consumer Financial Protection Bureau. Mortgage rules tightened, securitization changed, and large banks faced stress tests designed around severe hypothetical losses. Yet the central lesson is not that one villain pressed one button. Lenders, investors, rating agencies, banks, regulators, borrowers, and incentives formed a chain with weak links everywhere. The boom turned risky mortgages into products, products into collateral, and collateral into borrowed money. When home prices fell, the losses traveled backward through every promise. That was the 2008 financial crisis. How the money was made, how the risk was hidden, and how the bill reached everyone. Like and subscribe for the next boom and bust story.